In the world of currency trading, few developments stir as much intrigue and debate as shifts in the Japanese yen, JPY. On Wednesday, the yen extended its upward momentum for the second consecutive day, dragging the USD-JPY pair down to a fresh daily low near the 147.5 mark during the European session. What's driving this? Some investors are diving into the yen despite mixed economic data from Japan, sensing opportunity where others see uncertainty. But here's the twist. This move isn't just about domestic numbers. It's deeply intertwined with global monetary policy expectations. The Bank of Japan, BoJ, remains a key player in this story. Despite unimpressive figures like Japan's shrinking exports and a surprise drop in manufacturing machinery orders, traders are betting that the BoJ will stay on its path toward policy normalization. This means potential interest rate hikes before the year ends, a scenario that contrasts sharply with what's expected from the U.S. Federal Reserve, Fed. While the Fed faces speculation over aggressive rate cuts, the BoJ's hawkish stance offers a lifeline to the yen, bolstering its safe haven appeal amid cautious market sentiment. But let's break this down further. Earlier in the day, data revealed that Japan's core machinery orders rose by 3% in June, defying predictions of a decline. However, this growth was uneven, driven primarily by non-manufacturing sectors, while manufacturing lagged behind. Meanwhile, Japan's trade balance swung into deficit territory, raising concerns about the broader economic outlook. Yet instead of sending the yen spiraling downward, these factors were offset by the central bank's optimistic inflation forecast and commitment to tightening if conditions align. It's a delicate balancing act, one that keeps traders guessing. On the flip side, the US dollar has been climbing to a one-week high thanks to fading expectations of drastic Fed easing. Investors seem hesitant to push the USD-JPY pair too far without clearer signals from upcoming events, such as the release of the FOMC Minutes and Fed Chair Jerome Powell's speech at the Jackson Hole Symposium. These moments could redefine the trajectory of both currencies, making them must-watch events for anyone involved in forex markets. Now, here's where things get controversial. Should traders trust the BoJ's resolve to tighten policy when inflation remains stubbornly low, or is the market misreading the Fed's next moves? These questions aren't just rhetorical. They're critical for understanding whether the USD-JPY pair can break out of its current three-week range or remain stuck between support at 147.00 and resistance around 148.60. Technically speaking, Tuesday's failed attempt to breach the 148.00 level signaled bearish pressure. Still, oscillators suggest caution before jumping to conclusions. A decisive move below 147.0 could trigger a sharper decline, potentially retesting last week's multi-week low near 146.20. Conversely, sustained strength above 148.0 might pave the way for a rebound toward 149.0. To add another layer of complexity, consider how geopolitical tensions or resolutions could sway sentiment. For instance, optimism around a Russia-Ukraine peace deal could weigh on the yen, traditionally seen as a safe haven. How much should traders factor this into their strategies? As we wrap up, take a moment to reflect. Are you leaning bullish or bearish on the USD-JPY pair? Do you think the BoJ's hawkish tilt outweighs the Fed's dovish hints? Share your thoughts in the comments below. We'd love to hear your perspective.